Hello everyone, here is a review video for your 5th comprehensive assignment, which is going to task you with preparing a statement of cash flows for a company and then doing a bit of ratio analysis. Starting with the statement of cash flows, the first thing a company needs when they sit down to do it is their income statement for the current year. So we're going to do ABC Company, and we see here that ABC Company has all of their information already filled in for their income statement, and ultimately they ended up turning $1 million of net sales revenue into $30,000 of net income. Let me pull this up and make it a little bit bigger for you. We have all of their various costs going through. Some of them are real paid expenses, salaries and wages expense, etc. Some of them are not, like depreciation expense is a non-cash expenditure. So we're going to need this information because we're going to need on our statement of cash flows to adjust this net income that we got to the ultimate amount of cash that our operations provided us. We're going to do so using the indirect method, which means we're going to prepare that statement of cash flows by tracking our changes in some of our accounts. And to do so, we're going to need a comparative balance sheet. So a balance sheet that has the last 2 years worth of numbers. For ABC Company, we have their 2021 balance sheet listed here in comparison to their 2020 balance sheet. And we can see a few things looking at this. They increased their total amount of assets, they increased their total amount of liabilities, they increased their total amount of equity. We also have our end number here. The statement of cash flows, the end game of it is to figure out, do all of the various inputs that you had, your cash provided from operating, investing, financing, etc., add up to your change in cash. And here we see that from 2020 to 2021, their cash increased by $16,000 from 74 grand to 90 grand. So when we prepare our statement of cash flows, that's our answer. We have to come up with a net increase of $16,000 on that document. Some information can be obtained, most information can be obtained from the balance sheet and the income statement, but there are times where you're going to have to go through, look back at your records, and do a bit of calculations to figure out the numbers that you need to put on the statement of cash flows. And for that, we have a formulas tab that is already set up. It gives us some background information to use, and it also gives us a few templates over here to figure out, in this case, what we paid in cash for the acquisition of plant assets and what we paid in cash for dividends. What else do we have to work with? Well, we know ABC Company discarded plant assets with a book value of $14,000 and took a loss on the disposition of these assets. So they threw out an asset that their book said was worth 14 grand. If they threw it out, they got 0 for it. So they took a loss in total of $14,000 on their income. That $14,000 would have reduced net income, but it wouldn't reduce cash flow. It's not like you go and you throw something in the dumpster and then someone comes to you and says, hey, that was worth so much money, give me an amount of cash equal to what that was worth when you threw it out. You get 0 cash out of it. So that's an adjustment we need to make. It's also the reason that they are reporting over here a loss on asset disposition of $14,000 on their income statement. Our next bullet point tells us that they obtained financing by signing a new note. Company did not make any principal payments on other outstanding notes, and therefore the difference in their notes payable account on their comparative balance sheet is the amount of cash that they received for signing a note. Okay, fair enough. If we took on more debts without paying off any existing debt, our debt would go up, our notes payable would go up. And you get cash at the time that you borrow from the bank that you sign that note, so the increase in notes payable is the amount of cash that's being provided by signing notes. So if we go back to our balance sheet, we can see here that our notes payable increased by $20,000 from 70 grand to 90 grand between the 2020 and 2021 business year. They paid cash to repurchase outstanding shares of the company's own common stock and treasury. Well, common stock is an equity account, or treasury stock, excuse me, is an equity account. Let's go to our balance sheet and see what happened there. They had $7,000 of treasury stock the year before. It's up to $8,000, so they must have spent $1,000 in cash to reacquire treasury stock during the period. They paid cash to invest in the common stock of another firm during the period, and they did not sell any existing equity assets, which means the amount of cash that they brought in for the purchase of these investments, or they paid out, excuse me, for the purchase of these investments must be the difference between what they're reporting as equity investments on their last 2 balance sheets. So we go there When we find equity investments, it was $40,000. It went up to $50,000. If they didn't sell any existing stock, which they did not, that means that they had to have paid $10,000 in cash to buy that additional $10,000 of equity investments. And then we have some templates here because we need to figure out the amount of cash that we paid to acquire plant assets, and we also need to figure out the amount of cash that we paid for dividends. Let's start with plant assets. At the beginning of the 2021 business year, what was ABC Company's beginning balance of PP&E? Well, when it equals, I'm going to go over to the balance sheet, and I'm going to see that at the end of 2020, we had $129,000. Well, if we had $129,000 of plant, property, and equipment when the 2020 business year ended, we must have had the same amount when the 2021 business year began. Whatever we had in PP&E on December 31st, 2020 is going to be exactly the same amount that we had on January 1st, 2021. So I'm going to start by bringing that $129,000 over. We disposed of $14,000 worth of assets during the year, which threw $14,000 worth of assets into the dumpster. A machine must have broke down. We figured it wasn't worth repairing. Didn't have the patience to go and scrap it. Whatever happened over here, we disposed of $14,000 worth of assets that we had in use sometime during the year. So I'm going to subtract out that $14,000. If we started the period with $129,000 worth of PP&E on our books, and we threw out $14,000 worth of that PP&E that we had, that means that we have $115,000 worth of plant, property, and equipment on our books still, which has been in service since the beginning of the year. Well, what did we end with? I'm going to go down to this cell. I'm going to hit equals. I'm going to go back to my balance sheet. We see here that at the end of 2021, we ended up with $160,000 worth of PP&E on our books. So the question here is, if we have right now $160,000 worth of PP&E, and we know that $115,000 of that is from our beginning PP&E, it's stuff that we had before that is still in service, how much must we have paid additionally to acquire additional plant assets during the period? And all you need to do here is subtract out what you ended up with from what you began with that is still in service, and it gives you the amount of cash that you must have paid to acquire plant assets. So ABC Company must have paid $45,000 during the period to buy equipment or to do renovations to their building or whatever it was. They paid $45,000 to acquire or upgrade plant assets. To figure out what you paid in dividends, you basically just redo a statement of retained earnings, which we're going to do here. The statement of retained earnings always has the same setup. It's your beginning retained earnings plus your additions, which would be net income, plus your subtractions, which would be dividends, gives you your ending retained earnings. Well, we have this information if we go and we look at our comparative balance sheet. Again, retained earnings is an equity account. It shows up on the balance sheet. So what did we have in beginning retained earnings when the period began? Well, whatever we had when 2021 began has to be the same number that we had when 2020 ended. And if we go down here, we see that we ended 2020 with $25,000 in retained earnings. So that's got to be our beginning balance for 2021. And I bring that number on over. Add to that our additions, our income for the period which, if we had not paid out anything, we would have added all of it to retained earnings. So what was our net income? That's the bottom line of the income statements. The income statement says we had $30,000 of net income. So if we had $25,000 of retained earnings when the period began, and we made $30,000 during the year, had we not paid dividends, we would have had a retained earnings balance of $55,000. Do we have a retained earnings balance of $55,000? So let's go back to our balance sheet and see what our retained earnings balance was for the 2021 business year. And we see here, we only have $34,000 of retained earnings. Curious. We could have had $55,000, but our ending retained earnings is only $34,000. Well, to get from what could have been to what actually was, we must have paid dividends. So what amount of dividends must we have paid during the period? We must have paid $21,000 in cash dividends.